Welcome to the long and the short. In the last episode, we looked at what happens to a stock when it enters the Nifty 50. The short answer was the real edge is in the 12 months before inclusion, not after. But it's not easy to predict which stock will get included in the index a good year before the actual inclusion. But after the stock enters the index, the 2-week window shows a clean signal. But beyond that, the performance quickly fades. Today, I flip the question. What happens to a stock when it gets kicked out of Nifty 50? I think that was too dramatic. Let me say it again. What happens to a stock when it exits from Nifty 50? If inclusions told a story about momentum being built and lagging effects of liquidity absorption, exclusions should tell the opposite story. And with a few surprises along the way, they do. This is episode 2. We covered inclusions last time. Today, it's all about exclusions. Some disclaimers before I get started with the next section. The examples and ideas shared in this episode are strictly for educational and illustrative purposes only. Nothing discussed here should be construed as a recommendation, investment advice, or a solicitation to trade. Trading in stocks or derivatives involves significant risk and can result in complete loss of capital. The examples and data presented here are meant to explain market behavior, not to suggest that similar outcomes will occur in future. Also, specifically for this episode, I have excluded all merger and demerger events from the dataset. Only stocks removed through the regular semi-annual rebalancing process are included. Let's start with a quick recap of the mechanics of index reconstitution or rebalancing. As I had shared in the previous video, NSE reviews its Nifty 50 constituents twice a year, March and September. The data cutoff date is Jan 31st and July 31st respectively. All changes are implemented from the first working day after the March and September F&O expiry, with 4 weeks of advance notice to the market. A stock gets removed when it no longer belongs in the top 50 companies by free float market capitalization, either because its free float market cap has shrunk relatively to other stocks due to its price going down, or because its liquidity has deteriorated below the impact cost threshold, or both. Just as inclusions, exclusions come with a specific known consequence. Every passive fund and ETF tracking the Nifty 50 has to sell the stock that got excluded, and they have to do that by a specific date. That selling is known and anticipated. So instead of creating a burst of demand, exclusion creates sudden supply. Which raises the obvious question. If you know selling is coming, is there an edge in getting ahead of it and shorting the stock? If you are new to the concept of shorting, you may want to watch this video. Or alternatively, once the selling is done and the stock is out, is there a contrarian buy opportunity on the other side? So we looked at 33 exclusion events between 2015 and 2025 to find out. Same filters as before. We excluded corporate action-driven removals, mergers, delisting, and spin-offs. Only clean semi-annual rebalancing events have been included. So here's the hypothesis that we tested. Same 2 dates as before, the announcement date and the effective date. Our T0 is anchored to the effective date, the day the stock officially exits the index. We measured forward returns at 6 horizons: 1 week, 2 weeks, 1 month, 3 months, 6 months, and 12 months after the effective date. And we measured the backward returns over the same 6 horizons leading up to the effective date. The forward returns tell us what happened after the stock was removed. The backward return tells us what was happening to the stock's price before it got dropped. And when we put both together, we get the full picture. So let's start with the backward returns, because this is where the story actually begins. Now compare what you see here against what we saw in inclusions. With inclusions, the 12-month backward return was plus 58% in terms of mean, plus 43% in terms of median, with a 93.9% win rate. Almost every included stock had been a performer before it got added, which we had discussed, and there are obvious reasons for it. Here, it's almost the exact opposite. The 12-month backward mean return is at minus 11%, the median is at minus 16%, the win rate is at 33.3%, meaning 2 out of every 3 excluded stocks had actually been negative in the year before they got dropped. Go back 6 months, the mean is plus 3%, median is minus 3%, and a win rate of below 50%. 2 weeks before exclusion, a mean of minus 2%, a median of minus 2%, a win rate of 30.3%. The story is consistent. By the time a stock exits the index, it has already been underperforming for an extended period of time. This is the same pattern we saw on the other side. Inclusions followed performance. And the opposite applies for exclusions. Logically speaking, the stock got excluded because it underperformed. But the short-term picture is noisy when it comes to backward returns. Look at the 1-week mean of plus 2% and the max return of plus 115%. That extreme upper tail in this case is a single event. Yes, we're talking about Yes Bank, where all the shenanigans happened in March 2020. The standard deviation of 21% over 1 week is enormous. What this tells you is the signal in the very short term before exclusion is basically noise. The signal that matters is actually in the medium to long term in terms of backward window. All that it says is by the time a stock is removed from Nifty 50, it has already paid a heavy price. But like inclusions, it does leave us with the same question. Can you predict an exclusion? And compared to predicting an inclusion, which one of it gives us a better payoff? I'll leave that to you. Well, we looked at backward returns. Now let's look at what happens after the stock is out, that is the forward returns. The first thing I want to point you to is the 2-week window, because that's where the exclusion story diverges sharply from the inclusion story. With inclusions, the 2-week window was the sweet spot. Win rate was at 78.8%, a mean return of plus 2.21%, a median return of plus 3.07%, clean and reliable. Well, even with exclusions, the 2-week win rate is at 81.8%, actually higher. But the mean return is essentially zero. The median is at plus 0.02%. Now think about what that means. You are right more than 80% of time, but you are making almost nothing. And that's because when you are wrong, you are down minus 56%. A single catastrophic loss is wiping out everything the other trade generated. And therefore, this is not the same signal as inclusions. Here we have a high win rate with near zero average returns and a massive left tail. It's a very different animal from the inclusion 2-week effect. You see, the shape of the distribution matters as much as the win rate, meaning we want to have winners that win bigger. One reason for this non-existent but slightly positive returns could be that even though the stock gets excluded from Nifty 50, there could be other funds which track Nifty Next 50 which have to include it. Now let's look at the 1-month window. Something changes here. The mean is plus 1%, but the median is plus 5%, and this is worth pausing on. When the median is higher than the mean, it tells you that the distribution is almost left skewed. Most stocks in the sample did reasonably well, but a handful did very badly and pulled the average down. The typical excluded stock 1 month out was actually up 5%. This is a different kind of signal. It's messier than the inclusion effect, but it's pointing to something real and interesting. Then at 12 months, the picture flips again. The mean is at 15%, median at minus 3%. Now the distribution is right skewed again, meaning a small number of stocks delivered massive returns. And look at that max of plus 272%, which seems to have pulled the mean up sharply. But the median stock at 12 months is actually slightly negative. What this essentially says is that when excluded stocks bounce back, they bounce back hard, but most of them don't. And most continue to struggle, hence a negative median and a positive mean. So far, we've looked at the return stats for both sides of exclusion, backwards and forwards. Now I want to shift to something more abstract, that is the larger problem with the idea of shorting an exclusion stock. Let's think about the logic for a moment. The most intuitive trade which we spoke about around an exclusion is going short. Passive funds have to sell, that creates forced supply, get short ahead of that selling and cover once done, simple. In the US markets, this trade had historically some traction on the downside around the announcement date, but it's been shrinking for the same reason the inclusion trade has. More participants are watching, which means the information gets priced in faster. But our data doesn't cleanly support the short trade in Nifty post-exclusion. The forward returns are actually positive, mildly but consistently positive, both in terms of mean and median across horizons. The market doesn't seem to be punishing excluded stocks after they leave the index. If anything, the pressure goes the other way. So what about the long side? What about taking a contrarian trade, that is, buying excluded stocks on the basis that the selling pressure is done and the bad news is already priced in? Well, the 1 month median of plus 5% is interesting. The 6 month median of plus 4% is also interesting. But the standard deviations are big at 16% at 1 month and 39% at 6 months. On top of it, the negative tails are severe. So the honest answer is this: there may be something in here, but it is not as clean as the inclusion effect. Not nearly as clean, that is. The inclusion trade at 2 weeks gave us a reasonably contained and reliable signal. You see, the thing is this: the exclusion story is messier by nature, because excluded stocks don't all fall for the same reason and don't all recover at the same rate. And sometimes they don't recover at all. So what next? Well, I thought it's worth digging deeper into the fallen stocks to see if some pattern comes out of it. Here's what we see in the data. Not every excluded stock is the same. When we look at that 12-month forward distribution, plus 272% max, minus 72% minimum, plus 15% mean, minus 3% median, we are looking at a data set with two very different populations or return profiles mixed together. The first group are stocks that fell out of the index due to some temporary underperformance, maybe a sector going through some kind of a down cycle, a company navigating a bad quarter or a year, fundamentally sound but momentarily out of favor. These are what we can call fallen angels. After exclusion, sometimes the selling pressure goes off, the news flow normalizes, and the stock recovers. And some of them recover spectacularly. The second group are the stocks that got removed because something fundamental broke. A structural decline in their business, governance issues, a sector in long-term trouble. These stocks kept going down even after removal. I'll call them fallen knives. The exclusion dataset contains both. When you look at them together, the averages tell you one story and the medians tell you another. Separating the two groups, that is, identifying which excluded stocks are fallen angels and which are fallen knives, is where the real research problem lies. And that is not something you can solve with win rates and averages alone. You need more context. You need to look at the nature of each exclusion, that is, each stock. You need some sector context, valuation at the time of removal, and earnings trajectory. And even then, the answer may not be clean. So here's my takeaway. In essence, when it comes to exclusions, especially forward window, the data is hinting at a contrarian opportunity, that is a buy trade. But as you saw, it's not a reliable signal and not a simple one either. But if there is something, this is it. So we now know what happens to stocks once they exit the index. We also know why some of them do well and some don't. But to look at the entries and exits from a different vantage point, we asked a different question. How many stocks entered and exited the index in the decade-long period we studied? 14 out of 33 inclusion stocks also appear in the exclusion dataset. That's 42%. So nearly half of all the stocks that entered Nifty 50 over this period eventually got kicked out again within the same 10-year window. So in a way, the index is not a one-way door, it's a revolving door for a surprisingly large number of stocks. So one way to think about it is for the 42% of included stocks that eventually leave, the buy on inclusion trade carries a hidden risk. You may be buying a stock from the index which may eventually get kicked out. which obviously brings with it its own set of complications. So do factor in this point, and it's super interesting. So what does all that research leave us with finally? Well, the inclusion research gave us a clear message. There is a real 2-week effect after the stock enters the index. It's modest, but it's clean. The exclusion research gave us somewhat more complex outcomes. The pre-exclusion data confirms what we'd expect, that is, by the time a stock is removed, it's already been struggling. And there's no edge in shorting what has already fallen. Predict exclusion if at all, but it's harder to do that compared to predicting inclusions. The post-exclusion data is both interesting and ambiguous. The average excluded stock does recover on paper, but the median doesn't, and the variance is enormous. What the data is really pointing at is some sort of a K-shaped outcome. I said that to sound like an economist, but it's actually true. As we've seen in the data, we either have fallen angels, which are more likely to recover, or we have fallen knives that keep falling. If you really want to test something on the exclusion side by yourself, I suggest starting with the Nifty Next 50. That is the other side. Check when a stock is removed from Nifty 50 and see whether it qualifies for re-inclusion in Nifty Next 50. Some of the biggest recoveries have been in stocks that exited the Nifty 50, spent a cycle in Nifty Next 50 and worked their way back into Nifty 50. More on that possibly in a future episode. For now, that brings me to the end of this 2-part series on index rebalancing, inclusions and exclusions. 2 different stories from the same underlying mechanism. Do leave your thoughts and questions in the comments, particularly if you ever traded around the Nifty inclusion or exclusion event. I'd be curious to hear what you saw. Take care, trade safe, and see you in the next one.